Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Well, welcome back. First thing I want to do is thank everybody that came out this morning. We had a workshop at Tri-Cities Corporate College on East Side, and a lot of people showed up. We had a lot of fun. At least I did. Yeah, I hope they had fun, and I hope they got some pretty valuable information. We were talking about tax avoidance, and there's some different topics there that we covered. We also talked about a little bit about some of the strategies and some of the developments. I wanted to kind of continue that conversation on today's show. Developments in the economy that should lead to pretty decent stock markets, should lead to continued economic growth, which is always a good thing, unless it's highly inflationary, and then that's a little tough, but we're not there yet, so we haven't gotten to that point yet, and hopefully that stays away for quite a while longer, because that would always help. And so there's a lot of really good stuff that we talked about. We've got to going to continue those conversations. I'll have workshops in the future where we're going to be talking about some specific things you might be able to do. And one of the things that I didn't talk about that I kind of wanted to talk a little about and forgot was the tools that we have available to us now are substantially improved, and they've been constantly improving over the past 30 years that I've been in the business. When I look back at what we used to do and how we did it and how we do it today, we've come a long way. We've really come a long way, and it continues to evolve. And I really like it. I like what I see. However, it's very confusing for people who don't spend a lot of time in the industry. It can be incredibly confusing. I know BlackRock is one of the larger asset managers on the planet. They do a very good job. $6 trillion in assets under management now, and they provide an awful lot of tools. They've invented and created a tremendous number of products. That's a great thing. One of the unintended consequences is that you have to have a dictionary to look up a lot of the terms that they use to describe a lot of that stuff, and it's time consuming. So if you're not doing this every day, I can see this would get really tough over time. And the things that people have a tendency to look at, the past performance over the past 1, 3, and 5 years, not helpful. That is, by itself, that can be downright dangerous. If you're just looking at the 1, 3, 5 year, even 10-year track records, that can be really a dangerous way to manage your money. You really need to look a little bit behind the scenes, see what they're doing with the money. I talked about a gravitational pull towards what I call the central value, or the value the stock should normally be selling for. It's a relatively simple concept. And it goes like this. There is a value a stock should normally be selling for, and it's basically a range of prices. And stocks have a tendency to get highly appreciated above that value. They tend to go up a lot higher than they should, and they have a tendency to go a lot lower than they should. So if you know where that central value is, and that's actually going to be the theme of the next workshop that we do, because I feel like if you understand this, and it's not that hard to understand, but if you understand this and you look at the holdings that you have in your retirement plans, the 401ks, the IRAs, you can get a pretty good idea of how risky or how aggressive your fund managers are being. Think about that. So not only can you look up the 1, 3, 5 year track record, which everybody on the planet can do, but you can see how much risk they were taking to try to achieve those returns. And that's where, that's one of the jobs of your financial advisor, is to not only locate strategies that have done well over time, but also manage the risk well, because that's probably the most important factor. If you're in an investment that's performing very well, but it's too volatile, and you didn't know that it was going to be really volatile, you have a tendency to pull out of that investment when it's down because it's down a lot. Or maybe it hasn't done well over the last 3 or 4 years, and you just don't know any better. But yeah, that's pretty common. If you look back over the past 25, 30 years or so, or even 50 or 100 years, that has a tendency to happen. If you were not aware of that, you'll probably think something is wrong. You'll leave, and then when the big performance kicks back in, you miss it. That's the number one problem with people in their investments. They're not familiar with how that money is being managed. And I understand the prospectuses are written with incredibly complicated language. You have to get a dictionary of investment and accounting terms to understand what they're saying. That's where what they've done is they've created a job for people like me. People who read it, understand it, and then try to translate it into English or translate it into everyday language. And I'll give you an example. A value-oriented fund. A couple minutes ago, we were talking about that central value. There's a value that stocks have a tendency to come back to over time. It's kind of like gravity. You can defy gravity for so long, but sooner or later, plane has to land. Unless you shoot something out in orbit, But the bottom line is gravity is a very strong force, and there's a central value of a stock that's also a very strong force. And eventually, it'll pull the stock back to that level. And then it starts to go either higher than that again or goes lower than that again. And the types of investors that focus on companies who are selling below those standardized values are called value investors. They like to buy stuff that they think should be selling for more. And when you see that, in fact, we talked about the Bullington Capital Value portfolio. What does it do? It looks for value. How does it do that? It looks at a measure of income the company's generating and divides it by the price of buying the entire business, including the debt, so that you can get an idea of you can get actually a yield. Let's say, and by the way, the exact formula, I'll be putting it up on my website soon. But let's say the yield is 5% and the yield on another company is 10%. Which one would you rather have? The one where you'd get a 5% return or a 10%? Obviously, 10%. But if you didn't know how to do this, you wouldn't know how to calculate those numbers. And that's what a value-oriented manager does. They go in, they take a look at the estimate of what they think the company is capable of earning. They look at how much they should actually pay for that. And if it's selling for less than that, they'll buy. Quite frankly, it's that simple. Now, they will use a lot of really flowery, can't even say that, flowery language to tell you what they're doing. But that's essentially what you're doing. Okay, there's that central value. Is it above that or below that? If it's below it, we might buy it. If it's above it, probably not. So that's value investing in a nutshell. Growth, on the other hand, looks at how the company's growing. It might incorporate price movement. A lot of them do. Whenever you hear or see the word momentum now, which is in a lot of exchange-traded funds, whenever you hear that or see that, now you know that they're adding price movement to their calculations on what they think the values ought to be. And that's kind of the opposite end of the spectrum. Those companies are buying stocks or investing in stocks that are going up right now. And the other ones are investing, the ones that are trying to buy stuff that's underpriced are probably buying stocks that have been going down because that's what makes them undervalued when their share price drops. So you've got two successful strategies, and they're on the polar opposites of one another. One is trying to buy low, sell high. One is trying to buy stuff that's going up really quickly right now. And you know what? In the long run, they both work pretty good. Most people tend to like the value-oriented stuff. I like the idea of buying something when it's on sale. The vast majority of investors, and professional investors too, tend to prefer that style. Now, you've got a smaller group. They've been growing, but it's a smaller group that likes to say, okay, I don't really know, and nor do I really care that much of trying to figure out the actual value. I just want to buy stuff that's going up right now. It's going to make me money right away. And they're a big part of the market. It's a big part of the market that exists out there. So they are literally on the polar opposite of the other guys. And if you look in the long run as to how well those strategies do, they're like within 1 or 2% of each other. I mean, there's no clear winner. In fact, the winners appear over a 4 or 5 year time period to be whichever one's just done the best. It'll push it far enough ahead of the other one that everybody thinks, oh yeah, that's the one always going to win. And then the other one kicks in for 3 or 4 years and catches up or passes it. So that's why I like to have both of them in portfolios. And in addition to that, with BlackRock, they've and I'll tell you, $6 trillion. That's how much they manage. That's one of the reasons you probably want to pay attention to what they're doing. And thankfully, we work with them fairly closely. We also work with First Trust. And next week, I'll talk a little bit more about First Trust because they've got an event coming to Cleveland near the end of August. It's basically you have to be a registered investment advisor to be able to attend. Sorry. But they're bringing in economists who have contacts and have worked at really high levels of government. Why is that important? Well, because they can get information that you might not be able to get any other place. And it's all legal. They're people they used to work with. So I like hearing about that kind of stuff because, with the era of fake news, very difficult to figure out who you can trust out there. Even with some very, I guess, how would I say it? The high quality publications. Occasionally, somebody fools a reporter and gives them some bogus information, and it makes it into a high quality publication. So I like talking and listening to the talks from people who have a lot of connections, to make it just that simple. They've got the connections. They know what's going on. And by the way, it's not like you can't read the Fed's minutes. They do publish that. It is free. And they're pretty open. They talk about it. But these are guys that are going a step further. And that's one of the changes that has occurred over the past 5 to 10 years. They've really focused on people like myself. We're not the multi-billion-dollar institutions out there. But collectively, we add up to a lot. So they've actually come to the point where they're providing a lot of research, a lot of data. So we get First Trust, BlackRock. What's interesting is these guys are publishing their opinions and they're acting on their opinions. So when you see them doing something, they've got the ability to kind of fulfill that prophecy themselves. That's why you want to pay attention to it, or that's why people like me want to pay attention to it. Because I know, for example, I'll give you a real good example. There's an exchange-traded fund that invests in global technology. I just started looking at it. They just added this not too long ago to recommended portfolios in one of the BlackRock portfolios. So they just recommended this. I'm going in and I'm looking at it, and I'm going, that's pretty funny. That is we've been talking about this for quite a while. I talked about it this morning. I'll be talking about it for the next 5 years. There's a technology that's called 5G. It's going to change an awful lot of industries. It already is. And it's just in its infancy. It's within the first couple of years. It's a technology that allows data to be transferred at a super high rate without draining a lot of resources. In other words, you don't have to have a lot of equipment. The equipment for it is relatively small. You can add it on to the existing equipment, which is the way that it's being done right now. Now, eventually, it will replace the existing equipment. But the way that that's done is they add it side by side so you can use both because it's not backwards compatible. So the new devices that come out that can use the 5G are using it. and devices that need 5 or want 5G but need the 4G because in some places the 5G is not even available. They have both. And that's the way that it's going to go for the next 4 to 5 years. So I'm looking at this, and that's going to change everything again. Just like the internet changed everything, just like Qualcomm's technology is the reason you can send text and video on your cell phone, and the reason that they're doing some rates now that are flat. You know, they actually predicted that everybody would have access to everything all the time. Back in 1996, which think about that's 22 years ago, they were predicting that it would be $75 a month. Well, we still haven't reached that one. Now, we will eventually. But that changed, their technology changed the way all the cell phone companies operate. And a lot of the internet through Wi-Fi. It's changed the way, and it's created an enormous amount of opportunity, an enormous number of jobs, an unbelievable amount of equipment has been sold, and now it's happening again. And that's a good thing. That's a great thing. So, long story short, BlackRock comes out with a global technology fund. Woohoo! They're reading and listening and paying attention. And by the way, they can get a meeting with any CEO they want because they manage so much money. And they're saying, yeah, this is not going to be good just for U.S.-based companies. We think this is going to be good for companies all around the world. And it is. So they decided to create a fund that way. I decided to take 4 exchange-traded funds and concentrate just on the semiconductor industry because I believe that they will benefit the most. But it's not like it's 1 or 2 companies. It's going to be dozens of companies. That's why I needed 5 funds to get them all, because the funds are all structured differently. There is some overlap. There's not a tremendous amount of overlap. But in order to get every nook and cranny in that particular industry, I had to use the 5 funds that are available right now. There may be some more in the future. I'm probably sure there will be. But right now, I think that's really going to benefit from what we're seeing. If you look back in the early 80s, there was this technology, it was called seismic. They were using it to locate oil. Prior to using that technology, they would drill a well, and 1 out of 2 wells that they drilled came up dry. They would miss. They missed the oil. I hear the music. That means I got to take a commercial break. We'll finish that thought right after we come back from this commercial break. This is Bill Bullington right here on 1420 The Answer. Stay tuned.
Wish the officer had known what a day today has been. Then I stumbled through. Prison under open skies, everything breathing, praising God, in the company of all who love the
And we're back. Hey, feel free to call us, 216-901-0945, 216-901-0945 if you have a question or comment. And, I was thinking during the commercial break, we had a couple people come to seminars that have come many times before, and one of them used to be a floor broker on the Chicago Board Options Exchange. And he's got a little meetup group going, so we're going to try to see if we can get him. His name is Joe Waterman, by the way. And he teaches some really interesting stuff. They're pretty sophisticated options strategies. And right now it's free. So I know I get some calls here occasionally from people who would like to know more about that. And they're typically asking me questions about it. I will tell you that to do that, you need to find someone who's highly skilled and highly trained in that area, because coming into that area uninformed is not a good idea. You really need to get some training. And I passed the options principles exam. That had to be 20 years ago. I haven't really worked in that market or in that area for an incredibly long time period. He still does. He trades his own account, and he shows you the techniques that the floor brokers used to use. So maybe we can get him to call in and give us a shout out here, give us his phone number or something. And the reason I bring that up is I know that there are people that are interested in that. And you need to get with somebody who really knows a lot about that and is comfortable with it. to basically so that they can keep you from taking too much risk. Because with options, you can lose an enormous amount of money in a relatively short time period. And you can actually lose more than you stood to gain. And in a really bad scenario, I mean, you could just do a lot of damage. So you really need to know what you're doing. And you really need to have guidance from somebody who does this on a full-time basis, which I know Joe Waterman does. So he was asking me what I wanted to mention this. My answer was nothing. I'd like somebody that would be available to talk to people who have an interest in that, because quite frankly, I really don't. I know enough about it to know I don't have the kind of time it takes to do a good job doing that. And that could be really dangerous, if I started doing a lot of work with that. And I'll pick and choose my spots in that place, but it's nothing like the stuff that he does. So anyway, well, yeah, maybe we'll get him. We'll have him on future shows. And again, there's a website called Meetup. You can go to Meetup. I think it's called the Hudson Trading Company. That's his organization. And right now he's just doing free educational workshops. So I think that's kind of neat. Trying to figure out how he's going to put that into a business. And so that should be interesting too. And if you have calls, you can always email me, bill@bullingtoncapital.com, or you can go to the website. It's bullingtoncapital.com. There's a contact us form there. Feel free to fill that out. I will get back to you as quickly as I can. Just as quickly as I can. And one of the other projects, this is a mini project. I've been working on this for a long time. I really don't devote a whole lot of time to it, but I think this year I probably will, because I've gotten so inundated with questions about financial planning that I think, I've been giving the answer out, but when you just give somebody the answer, they have a tendency to go, oh, and then just walk away. Understanding the answer is kind of key, and it's not as complicated as you might think. Most things are not all that complicated. Some are. I mean, some are necessarily complicated. We're looking at ways of avoiding taxes. Well, there aren't a tremendous number of them. There are some. They tend to work fairly well. Most of them are just common sense, actually. We're not allowed to give tax advice. So whenever you hear from me, I have to tell you, by law, you should go talk to a licensed tax preparer and run that by them. So, which is what I do. Anytime I hear of an idea that I think is interesting, I just call my tax guy. And I've got one on retainer so that I can call them and my clients can call them if they have tax questions. That's a vocation. Now, a lot of tax people try to give a lot of investment advice. Yeah, I don't think they should allow them to do that either. In fact, they're not supposed to. You're not supposed to give investment advice out if you're not licensed. That's going to stop anybody. But you're not supposed to do that. Professionally, it's not a good idea because you can actually run into liability there. But they're closely related. They're not the same. Taxes and understanding how businesses work, doing accounting, it is not the same as investing. It's not. The investments don't work like you think they're supposed to. They just don't. You think stocks are supposed to go up when the economy is doing good and they'll start going down. Why is that? Well, because the expectations are changing. It's not based on what's happening right now. It's what they expect to happen in the future. And unfortunately, to know what that is with a high degree of accuracy, you'd actually have to take a poll of every single potential market-moving participant, which number in the thousands, and find out and see if there was a consensus in feeling. What you're going to find out most often is that there doesn't seem to be a big consensus. And that's a thing I find almost laughable, as you're polling all these people who have very similar backgrounds, very similar training, and they all have different opinions. And that's one of the reasons I laugh about this all the time. I studied economics in college, and they called it the dismal science. That's why. Because depending on who you ask, you're you're probably going to get a slightly different answer. Sometimes the answers will be a lot different. And hence the name dismal science. You can't get a lot of continuity in the answers that you're getting. And you never know when certain factors are going to come into play in an economy and when they're going to go away. So doesn't mean that you don't try. No, actually the economies are relatively predictable if you look far out into the future. And although it's not perfect by any stretch of the imagination, but when you're looking just over short time periods, and short is anything less than 5 years, anything less than 5 years, your guess is as good as mine or anybody who's telling the truth. There are a lot of people that will tell you that, they know what's going to happen. They've got a crystal ball that works or something along those lines. Yeah, I've got this method or systemology, that we're going to apply, and it's done this in the past. Yeah, okay. I like what Peter Lynch had to say about that. He said he didn't spend more than 5 minutes reading an economics report. Not more than 5 minutes in his entire career. Now, this guy beat everybody's record, by the way. He's got the best long-term track record of a mutual fund that was available to the general public, regular mutual fund. And didn't spend more than 5 minutes reading the economic reports, which I think is funny because you know what? Somebody showed him when he was in business school, and actually he was probably his employer, showed him the correlation between economic activity and stock market activity. And the correlation was so low that it was considered statistically insignificant. In other words, it didn't matter. The stock market moves on expectations, and expectations change pretty quickly. And they don't tell you that their expectations are about to change. They just do. That's one of the reasons that there are more value investors than there are momentum investors, people who are looking at price movement. Because a value investor can identify companies that seem to be undervalued based on things like assets, sales, and earnings, something that are highly measurable. The price movement is basically based on emotion, which is not highly measurable. It's very difficult to measure. There are some ways to do it, but they're more uncomfortable than saying, for example, I really like Procter & Gamble because it's got X dollars in sales. Their profit margins have averaged this over time. They make products that I can understand. The products are relatively low cost. It's not like you're buying a new jet. You're going to buy some Tide this week. So all that stuff. By the way, I keep forgetting to give the phone number out here. It's 216-901-0945 if you'd like to call in. I'm going to go to the phones right now, and I got JR.
Good morning, William.
Hey.
How are you?
Good. How are you?
I very fine, thank you. I have two stocks that are polar opposites I'd like your opinions on.
Sure.
One I've been in for a while. I've made good buck on it. It's called Qualis, so we've talked about it before. Mm-hmm. It seems to have hit a trading range now, bouncing between 95 and about 87. It's got, at 95, I think it's pretty close to being fully priced, but we thought that back at 70. Currently, it's selling at about 137 times earnings. And could you give me a little thought on that? I mean, 137 times earnings, obviously it's a growth stock. I think its sales have gone from about 100 million to 200 million within the last year. But hold, buy, or sell?
Well, if you were looking at a valuation and you're a value investor, you wouldn't be holding this stock.
Okay.
Because the revenue over the last 12 months, even though it's up 22%, which is a big number, 22% increase is huge. Mm-hmm. The market cap or the stock market value of their stock is $3.7 billion.
Mm-hmm.
Okay, so $242 million to $3.7 billion. That's 15, almost 16 times its annual revenue, not its profit. Its annual revenue. So obvious, this is just like Amazon and Cisco Systems and EMC were back in the late 90s. And, those stocks went up 3 and 4 times farther than anybody ever thought they would. Mm-hmm. Think about that for a second. They went up 3 to 4 times more than anybody ever thought they would. And then they crashed, and they took Microsoft to actually just now, just within the last year, got back to the price that it sold for 17 years earlier. So that's what I'm saying. If you're an investor, you're not in that stock. That's not a value under any stretch of the imagination. A trader, on the other hand, will be putting trailing stops on and, hopefully adhering to them and making some money on it. But that's not easy either, because that stock fluctuates a lot. I'm just looking at, here, going in, so from April 17th, actually April 18th, okay, last price on it was $84.45, and a few days later, a couple weeks later, it was down to 68. Okay, and then it pops up, goes to 96, then it goes down to 82. So that is a tough stock. That's what I have to say. Warren Buffett has this folder on his desk, and it's labeled "Too Hard." That's where I would put that one. It's too hard.
Okay. All right. There could be a trading strategy behind it, I would assume. If I've already made money on it and continue to sell covered calls, watching that it doesn't bottom out, I still could maintain a position and make a few dollars on, I would assume.
Well, you hope.
Yeah. Conservative move.
Hey, that's not conservative. You can't be conservative with this stock. It's not a conservative stock.
Okay,
so,
even with selling the call.
Yes,
covered
everything
call.
you sell a call. Let's say you sell a call for $3 at 95, and then it opens at 50 one day because they find out one of their big contracts got canceled. Okay,
is it really possible for a stock to go from 90 to 50 overnight?
Are you kidding?
You know, how often does that happen?
A lot more frequently than you would think.
That's where I'm asking you, Bill, because I say maybe 0.5% that can occur at some time.
Well, actually, it kind of happens kind of lumpy. So, like if one company in the industry all of a sudden has a problem, you'll see that company do that. And then if another company comes out with bad news, then all of a sudden a whole bunch of companies start, we should all air our dirty laundry at the same time because they're doing it. And that there's a group think going on there. So you'll see that happen more frequently, kind of in waves. And it doesn't necessarily have to do that either.
I assume you would agree that cybersecurity is a pretty much of a growth industry for the future, though, correct?
Sure, but you've already paid, and so has everybody else. I mean, you've paid for the next 10 years worth of growth in that stock. If you're holding on to it at today's prices, you're doing the same thing people did with Microsoft back in the year 2000. Microsoft was actually. This stock could actually go up another 2 or 3 times what you might have paid for it in 2013 because it could double again. If it doubles again, it will be slightly higher than the valuation that Microsoft achieved back in the year 2000.
I think what you're saying is it easily could double, but also could quadruple its losses just as easily. The risk side is greater than the growth side at this point.
Yeah, that's exactly what I'm saying.
Now, the next one is more of a long-term investment or perhaps a buyout opportunity. What do you think about Newell? I'm into that now. Newell has I got into it by a way of selling puts, and so it's rebounded a bit. I'm up about 5%. I was paying a 3.5% dividend. Is there any long-term value in that stock? You think?
No. You look at it; its price to sales ratio is just 1. Which is relatively good. The reason it's so volatile, though, Newell does a lot of commodity products, and it's hard to have a big advantage over other companies when anybody can make your product.
Sure.
Yeah. Hey, I got to take a real quick commercial break. You want to hang on?
If you wouldn't mind, sure.
Sure. Yep. Listen to Bill Bullington right here on 1420 The Answer. We'll be back after these messages. And we're back. Hey, you still there?
Yes, sir.
All right. I got...
go ahead. I'm sorry.
No, I looked up Newell Brands, which is Rubbermaid, for those of you that might not recognize that. at least the business portion of it. And I know why the stock is relatively cheap. But you look at the profit margins and the types of businesses that they're in, that's why it's got a low valuation on it, because the businesses really fluctuate a lot. And the profit margins also fluctuate a lot. And just as a general rule, the more a profit margin fluctuates on a company, the more volatile its stock price is going to be, and typically the lower the valuation will be. So I'm looking over the past, this goes back to 2005. They had years where they lost 17%. So for every dollar that they sold, they actually cost them 17% more than the dollar that they got.
Wow.
But 2017, their profits were 44% that one year. They probably sold a division off. I'm thinking. I don't know yet. I'd have to go back and look. But you can see several years where they've been 19, 17. So when you're going from a minus 17 to like plus 20, that's all over the map. And it looks that way. So the more uncertain a company's profits are, the more variability that you have, the more it's going to fluctuate.
Be discounted.
Yeah, and they tend not to sell it at a real high valuation. So.
Okay. So what I'm reading here is if they would have a reorganization or something of that nature where they'd have a lot of costs, that could influence that just as much as if they could.
Yeah, if they were to get rid of something, and my headset keeps going out. I'm not sure why, but so if it's going out every few seconds. Okay. And you hear me now?
Yeah. Yes, sir. Yes, sir.
Anyway, the more you see something like that happen, the more fluctuation, and it's still going out.
I can hear you quite well.
Yeah, sorry about that. There's something at the radio station that keeps turning on and turning off my headset. But, so I'll try to answer the question with this going on in my ears.
So the consistency of the return is every bit as important as the amount of the return. Is that correct, Bill?
Okay. Can you repeat that? I'm sorry.
Is the consistency of the dividends, the historical record, it is every bit as important as the amount of the return? Is that correct?
Yeah. Generally, that'll work that way. You want to see, most people love consistency. Mm-hmm. Most investors love consistency. So the more consistent it is, the higher premium companies like that will demand. So people are willing to pay a little bit more for them. And they really pay a big premium for a company that's got a big fat profit margin the way that Qualis does. Qualis has got that's why they paid so much for Cisco Systems and for Microsoft and for Intel, because they have had huge profit margins, and they were growing 20, 30% a year there for almost 10 years in a row. So, and everybody got to expect that was going to stay that way forever.
Sure. And
they started paying up to get that growth, and then the growth slowed down. And when the growth rate just slows down, you see what, stocks crash. They'll literally crash.
You don't want to be the last one in the musical chairs game.
Yeah. And it's so hard. You really don't know exactly when that music's going to stop. That's the really tough part. And that's why I like to just set up a set of rules that will help me capture a big chunk of those moves and just be happy with it.
Very good. All righty. Thank you, Bill. Have a good week.
Thanks for calling. Yep. You too.
Bye.
And sorry to make you hold, Joe.
Oh, no worries.
This is Joe Waterman.
Yeah, this is.
Okay.
Can you hear me?
Yeah, I can hear you. That's good. So I was talking about you a little bit earlier on the show, and we were talking about.
Sorry, I was trying to call in. I just didn't have the number, so I apologize.
Oh, that's okay. I should have given it out more frequently. I keep everybody keeps telling me to do that, and I keep forgetting. So if anybody else wants to call in, it's 216-901-0945, 216-901-0945. And I was telling people about you've got the meetup, and it's called the Hudson Trading Group. So if anybody wanted to meet with you personally, I'm pretty sure they could go there and sign up.
Yeah, that's correct. It's meetup.com, Hudson Trading Company.
Yeah, and why don't you give us a little bit of your background, the training that you got?
Yeah, sure. I think you might have mentioned it a couple months ago, but I was a floor trader or a market maker at the Chicago Board of Trade for almost 20 years. Mm-hmm. And at the end of my career, I was trading 30-year bond options on the floor.
Okay.
But I've also traded equities and some indexes too.
Yeah. And that's what kind of interested me. I get a lot of people that'll call into the show and they'll ask a lot of questions. In fact, our last caller typically would ask a lot of those questions. And
it's funny. You were talking about the Newell Rubbermaid.
Right.
And about a month ago, I think it might have been the same gentleman that called in. But can I tell you the trade that I put on when I heard that show?
Sure.
Or is that?
Yeah, no, you can.
So I sold the 24 put in September,
mm-hmm.
and I bought the 28.33 call spread for September.
Okay.
And I think the stock was maybe around like 25 at the time, and it's probably rallied, getting close to 28, I think.
Yeah, 27.80. Yep.
So I was that was a trade that I just put on. I think when that gentleman called in, because he was talking maybe about had a pretty good dividend yield or something like that in a big company.
Yep. Yeah. Absolutely.
So I was like, all right, I'll take it. I would be willing to take it below 24.
And see, all this kind of stuff, and this is why I'm really glad you called, because I'm just going to keep pushing people to you.
Awesome.
And you know what you're doing. I understand what you just said. That's a good trade. That's an excellent trade. But most of the people listening probably need to go and ask a few questions.
Totally.
Really, yeah. So, but hey,
totally.
I appreciate that.
The funny thing, that trade cost me, I think, $3.
Yeah. Yeah.
So.
Well, when he says $3, folks, what he means is $300.
Yeah.
Yeah. $1 is $100 in options. So that's the kind of stuff too that Joe can help you with, and you can help him with those the same strategies that you used on the floor, which I think is pretty interesting.
Well, and I think, and just to go back, I think where you're the average investor or like the listener on your radio show might be more interested in like covered call writing or something like that. That's a little more easier to conceptualize.
Yeah, absolutely. Yep. So from now on, I'm just going to say, hey, call Joe.
Perfect.
Hey, thanks for calling, and we'll try to get you back on next week.
Yeah, definitely. Thank you for having me on.
All
Appreciate
right, thanks. Yep. Bye. Got to go to John right now. John, I got a few minutes left. You have any questions for us?
Yeah. Good morning, Bill.
Hey.
Wanted to get your thoughts on Cedar Fair.
Cedar Fair. Well, I love the amusement park, and I really love the stock symbol. It's fun. F-U-N. And I look at the market cap. It's about 2.5 times its revenues. That's not bad. It's not bad. The dividend yield's pretty high on it. It's close to 6%. It's a stock though. It trades. Yeah, it's a stock. So it's going to be volatile. If you look at the prices as it's been in the past, 1998 it was $27. Okay, it's 20 years later. It's at 60. A lot of people go, oh, well, that's not very good. That's only about 3.5%. Actually, it's paid that plus the dividend. So the total return, the average annual return is probably closer to 9 or 10%. If you were reinvesting your dividends the whole way. Now, you'd have seen the stock price go down a lot. It went down to 17. Oh, somebody's getting pulled over. Hope that's not you.
That's just an ambulance going by.
Okay. So then in 2005, or 2004 rather, it gets up to $34. By 2009, it's from 34 all the way down to $8.90. And yeah, in 2009. So now it's at 60. So if you had the guts to reinvest your dividends over that whole time period, your return's probably closer to 13 or 14% a year.
Wow.
So if you were reinvesting the whole time and you've got nerves of steel, you could do very, very well with the stock. It doesn't appear like it's a great bargain right now, but it also isn't over. It's right around that central value I was talking about today in the seminar, where stocks should be. They'll stay within 15% or so up or down on where they should be about 80% of the time. Then if something bad happens, you can bet that it'll overreact and go below, and that central value may even drop in value. If the company starts losing sales or the profitability is permanently going to be affected, that central value might edge down. but the stock has a tendency to go down a lot further than it would indicate or that it would dictate. And that's where your value comes in. So I'd say when the stock went from 2004 to 31 to 2009 at $8.90, at $8.90, it looks like at that point, when you looked at the revenues back from that time period and the potential profit margin, you go, okay, yeah, everybody's got to buy that, but nobody wanted to buy in 2009.
Right.
Everybody was afraid of everything. And so if that were a stock in your portfolio and you got the dividend being reinvested and it's not more than a couple percentages or so, it could still have added a tremendous amount to your returns over the years.
Right. I read an article on Cleveland.com yesterday where they talked about their attendance being relatively flat. And I think, I've been there a couple times this year, and I think their prices are to the point where they're almost pricing themselves out of the market because it's not cheap to go there anymore.
Hey, John, could you call back in next week and we'll finish the conversation? Because I hear the music. That means I got to run.
Okay, Bill. Thank you very much for your time.
Yep. Thanks for calling. And thanks for listening, everybody. This is Bill Bullington. I'm here every Saturday morning from 11 to noon on 1420 The Answer. Have a good weekend, good investing, and good luck.
Broadcasting every Saturday at 11 a.m. on AM 1420 The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and or investment strategies recommended and or purchased by advisor, or product made reference to directly or indirectly will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional. The preceding program has been paid for by Bullington Capital Management, LLC.